Well, good morning all, and welcome to the BDO update on 3 crucial tax updates for not-for-profits in 2024. Lots of changes coming, lots of things happening. So I'd now like just to move to a little bit of housekeeping. We've got 3 presenters today. I'll kick off. My name is Russell Postle, consultant in the Brisbane practice. Judy White, one of our executive directors specialising in the NFP and the tax sector, and James Trainor, a tax specialist in Sydney. And so we'll go through the 3 topics with you shortly. There'll be time for questions at the end, so please feel free to submit questions on the tab and do that. Hopefully you've been able to access the pack. Reach out if there's any questions. But following the session today, there will be a copy of the slides so that you can see that. There'll be a link to the recording so that you can go back and listen to different aspects that might have been identified, and the contacts for the 3 of us should you have any particular questions you want to move on to. So I'll kick off now with the first part, the update on some broader taxation matters. So I'm just going to start with the question of the Productivity Commission's review of the philanthropy. So they're undertaking a question of how to increase philanthropy, but they have a number of questions and findings that they've issued. I've drawn it to your attention because the submissions close this Friday for this, and there's a couple of critical path areas that they're looking at. One is that they're suggesting that school building funds should lose their deductible gift recipient status. And they're arguing that because they say government now funds education a lot more than it used to, and they've this perceived risk of substitution of donations for school fees. Well, that sits out across a whole lot of different fields, where be it disability, be it homelessness, where the government funds. So it's a real question, and at BDO we're taking the position that we think the DGR status should be retained. They're also questioning the DGR access rules for charities. Should all DGR, the second question of deductibility, so should all charities get DGR status, and whether the full tax deduction for donations should remain. They're questioning maybe it could be a rebate, but then at the same breath they recognise that that would probably significantly reduce the level of donations made. So I'm not sure how that helps with the idea of increasing philanthropy. Do have a look at it. You can find the draft report on the Productivity Commission website, and I'd encourage everyone to put submissions in if those things are of concern. But let's look to the other change that is coming this year for the category of entity that's referred to as a non-charity, self-assessing as income tax exempt. So this is, so firstly, let's make sure we remind this is non-charity. So any entity that is a charity is not doesn't have this change coming at them. So it's all of the entities that are listed out in Division 50 of the Income Tax Assessment Act as being able to enjoy an income tax exemption. Things like your sporting clubs, associations for art, literature, and music, community associations, service clubs like Rotary, Lions, the employer and employee associations, so employer groups and trade unions, the associations that promote agriculture, etc., that are scattered around the country, some NFP-run hospitals, health insurers where they're not run by a charity, similarly public education institutions that are not charities, and there's a few of them, and scientific institutions. So this list of entities are ones that where the reporting requirements will change. So let's just now have a look at what this will look like as the new category. So if we move on to the next one, which is how it will be processed, is that it will form a new category of income tax return. So each year the Commissioner issues a list of tax returns that the ATO requires to be lodged, be it for companies, trusts, partnerships, individuals, and specifies who is required to lodge. All persons who derive assessable income, all trusts, etc. So for this year, there will be a new category, which will be these non-charities self-assessing as income tax exempt. So those where they have an ABN. So if they have an ABN, they are required to lodge an income tax return. And so the ATO has been compiling their list of all those that they believe are there with the ABN. So there will be then a matching of the ABN details with the legal structure, etc. So now this will be an electronic form only, because it's running off a whole series of drop-down boxes. So if you answer a question in a particular way, that'll open up to a different set of questions to if you answer it a no versus a yes on different questions. Don't be afraid. The financial data that is required is minimal. It's just a range. You've got to answer what range will be your estimated gross income. And so that's just going to be a very wide range, because for a lot of organisations that have a 30 June year end, they haven't completed their financial statements by the date which it's required to be lodged, which is 31 October. For many organisations, they'll be looking to later, if they're going to have an audit particularly, so they then need to take time and fit within the auditor's schedules. Substituted accounting periods need to be managed, and my discussions with the ATO is that's still something that's being worked through as to how they do that, because for a company, for a business, you need to apply for a substitute accounting period. So there's going to have to be a process to notify the tax office of a different period. For example, I help an equestrian club that has a September year end. So lodging by the end of October for a September year end will be a challenge. But they will have a later lodgement date under the substitute accounting, but we've got to get the process to update the tax office with that date. We did confirm with them directly that it excludes government entities. They are not required, even though they fit as one of the categories of the income tax exempt self-assessing non-charities. And something to remember always is that just being a not-for-profit doesn't mean there's no automatic that means it's income tax exempt. So there are many examples of not-for-profits that remain subject to income tax. So what will the focus of the questions be? It will be around the matching of the organisation. So we've seen recently some commentary around a couple of organisations one organisation that has generated multiple ABNs to deal with different components of the organisation. So I dare say that will have some challenges when they come to match the legal structure, the incorporated association number, or the company limited by guarantee, the ACN. The ATO will also look to match the GST and PAYG withholding links, so the data that sits on the ABN with the organisation. We expect that one of the questions will be, which particular paragraph of Division 50 does the organisation fit under? So, so you need to be able to say, well, what do we do? If you're a bowls club, well, it's about the encouragement of sport, and you can point to, it's this paragraph that is the encouragement of sport. And when you do that, it's good to just double check that what are the requirements to meet under that. And and then the question will be, does your organisation actually qualify as income tax exempt? I can tell you that the presentations from the ATO, and we had one at the Chartered Accountants just recently from the Assistant Commissioner, Jennifer Moltisanti, they're expecting to strike a number of entities that think they're income tax exempt, but are actually not. Organisations that look after members, there could be a whole pile of industry associations that may not fit under these rules. So they need to do that. And that's why it's important for you to be able to work out which particular section do we fit under. Thank you. And then, so the questions will be that, can you identify that you comply with all the two key requirements under Division 50, that you comply with all the substantive requirements in the governing rules? For most, that'll be a constitution. And that you can say we apply our income and our assets solely for the purpose for which the entity is established. Now, solely has had a lot of tests around the world of superannuation, and that word has been interpreted to mean equals 100%. So you need to be able to evidence that what that is. So a couple of steps for you to take. Step one is, do you consider yourself to be exempt? And does the organisation fall under that category of non-charity self-assess as income tax exempt? So that's your step one. Do we think we're caught by these requirements? And then step two is to identify which particular category, which paragraph of Division 50 do we fit under, and what are the requirements? Because if you said, oh, we're an employer association, then you need also to ensure that you have a registration with under the Fair Work Act. What are your substantive provisions of your governing rules? You should be able to say, well, here's a list of them. You know, examples, if you're required to have an audit, that you had an audit, that's part of it. What are your objects and your purpose? And have all your income and all assets been applied solely to purpose? So can you look at that and say, yes, I have, and the critical question on that will be being able to establish that, yes, you can sign off that you have done that. And then finally, do all your documents, your website and everything else, do they all support this view? In other words, if you have a website for your not-for-profit, does it show that, yes, it's all about, if it's, say, a sporting club, it's all about encouragement of sport, or does it talk about other things? So you need to ensure there's consistency of message. So lots of challenges coming up there for these organisations. And I know we've got one question which we'll come back to later in the topic. So I'll now hand over to James Trainor, who's going to take us down the path of some interesting tax questions, aren't you, James?
Absolutely, Russell. Tax is always interesting, so we don't need to specify that that's the case. But thank you very much for all that insight. I'm going to be talking about entities engaging workers, and I'm very careful in using the term workers, because what we're going to discuss today is a range of different types of workers that you might have working with your entity, and we'll talk about the characteristics of those sorts of workers. And we'll also talk about the obligations that arise, because there are different obligations depending on how you are engaging with each of those workers. So the first category we're going to have a look at is employees. So this probably forms the bulk of the workforce that not-for-profit entities will have. And they're probably well understood by most entities. So we're generally talking about an individual who is being engaged, or we will be talking about an individual, someone who is paid for their timed work and have hours set by either an employment agreement or some sort of industrial award or other type of legal agreement. Generally, an employee will receive paid leave, so they'll get sick leave, annual leave, recreational long service leave. And if we kind of think about the difference between, say, who an employee is and who maybe a contractor is, an employee won't be responsible for providing materials or equipment needed for their job. That'll generally be provided by the employer. And the employer will also have a lot of control over what that individual does. So they'll be instructed to perform the duties of their position, and the individual will agree to provide their personal services. And typically an employee will be recognized as integral to your business. integral to the work that you're doing in your entity. And the employee themselves really isn't taking any commercial risk. So whether their activities result in profit or loss is irrelevant for them personally, because it's that individual is acting on behalf of the entity that's employing them. So all of their actions get slated home to the entity that's is their employer. So that's someone who's an employee. So what are the obligations that arise for entities that engage employees? Well, there's the full suite, and I'm just going to list them out here. And at the end of looking at each of the different types of workers, we'll go into a little bit more detail as to what the actual obligations are. But if you're engaging an employee, then you're going to have PAYG withholding. So you're going to have to deduct taxes from the salary you're paying. You're going to have to report through single touch payroll all of those payments and the withholding. You'll also have obligations to contribute superannuation at the applicable rate. For entities, if they're not exempt for payroll tax, the payments made to those employees will also be wages for payroll tax purposes and also for workers' compensation purposes. And for employees, if you provide them with something that's a non-cash benefit or entertainment, for example, then that's going to be subject to fringe benefits tax, and the employer will need to step through the FBT requirements to determine is there an obligation. And Judy's going to spend a little bit of time talking about FBT in much greater detail. The second category of worker that I want to touch on today are directors. And a director is in many respects similar as far as the employer obligations go to an employee, although they are not technically an employee because they are not engaged under an employment agreement. They're actually appointed to act as a statutory director of an entity. And so your classic is a non-executive director. And it's important to note, you could have someone who is actually an executive director. So for example, the CEO of an entity might be employed as an employee, but also sit on the board of the organization. And generally we'd see with those executive directors, they're probably remunerated by way of salary rather than director fees, as you would get for a non-executive director. So notwithstanding, as I mentioned, that directors aren't employees, the employer obligations typically include an extension to cover directors. So that means that PAYG withholding, single touch payroll reporting is required, superannuation needs to be paid for your directors, payroll tax, workers' compensation, you need to check each state because some states give an exemption for non-executive directors, others include them all. And again, fringe benefits tax, the definition of employee includes directors when we're looking at fringe benefits tax. The third category of worker is an independent contractor. Now, independent contractors have been subject to much discussion and court consideration and ATO interpretation of late. And one of the significant changes that happened through some high court decisions over the last couple of years is that we've seen the courts focus on the terms of the contract. So the contract between the entity and the independent contractor. And if those terms satisfy the conditions that they are mainly being engaged to provide service to the entity, then they will be regarded as an independent contractor and not an employee. And the big change there is that the historic position is that you needed to look at what the individual is actually doing in their role. And that was the assessment. Whereas now we focus on the terms of the contract, still the same sorts of things we'll touch on in just a minute, but it's around an examination of the contract and what was intended when that contract was entered into. So an independent contractor could be an individual, colloquially known as a sole trader, but it could also be a contract with a partnership, a trust, or a company. So I might set up James Trainor Proprietary Limited as my company, and I, as an individual, am engaged by my company, but my company isn't engaged by a third party to provide services. And that's potentially what we're talking about here at the minute. So what are the characteristics that will identify someone who's an independent contractor? Well, some of the key things that distinguish an independent contractor from an employee is generally they're paid to achieve a result. So it may well be that it's to install something or to complete a project, but it's all about a result, as opposed to, for example, just merely paid a rate for a week or something like that. Now, it doesn't mean that one of these characteristics is definitive. You need to have a look at all of them. So certainly you might have a contractor who is engaged to work maybe 2 days a week or something like that, who could still be a contractor, but you need to step through each of the conditions that determine whether someone's a contractor or an employee. So typically an independent contractor isn't in receipt of paid leave, so they won't get sick leave, annual leave, recreational long service leave. A contractor will generally be responsible for providing all the materials and equipment needed to do their job. So they'll bring their own laptop, they'll bring their own phone, they might have tools or other sorts of things that they need to complete the task that you're engaging them to do. One of the key things that differentiates a contractor from an employee is the ability to delegate work to other entities and also to refuse work. And that ability to delegate is really key. Courts really focus on that, and the ATO guidance really focuses on the ability to delegate work. Now, it doesn't mean that it has to be delegated. It just means that they are free to delegate the work. So if you're looking at a contract, if the contract says that you are able to delegate the work, and it may be subject to certain approvals from the entity which is engaging that contractor, that should be okay. But again, you need to have a look at all of the terms and conditions. A contractor will generally be someone who provides services to the public generally and to other businesses. So not someone that works for you 5 days a week for 52 weeks of the year, but actually someone who sells their services to a range of different companies or other entities. And the final point is that the contractor generally is in a position to make a profit or loss from the work performed. So they might charge a rate or a fee to the company, but what they draw out in terms of, say, salary or dividend or something like that, might be less. So the entity that they're working for, the trust or the company or the partnership, would generally make a profit or loss from that. Now, obligations for contractors are very different than employees. So a contractor will typically issue you an invoice. There'll be goods and services tax if that's applicable for that particular contractor. Provided they quote an ABN, there's no obligation on the engaging party to deduct PAYG on the payments under that contract. Similarly, there's no single touch payroll reporting because you're not paying a salary. There may, however, be an obligation to report to the ATO through taxable payments annual report, and certain categories of contractors are needed to be reported to the ATO, and this is just targeting the black economy. Superannuation is something you just need to be really careful about. So if you have a contractor and they satisfy all the conditions to be a contractor, but they're a sole trader, then potentially you have super obligations for those people still, because superannuation includes not only employees, but it includes contractors who are engaged in their individual capacity. And then you need to look at some other factors to determine if there's superannuation for them. However, conversely, if you're engaging a company or a trust or a partnership, then there is no superannuation. Certainly if you're engaging contractors, it is easier from the engaging party if you're engaging with a company, trust or a partnership rather than a sole trader, just in relation to that superannuation. A payroll tax can also apply to independent contractors, and again, it doesn't matter whether it's a sole trader or a company. The payroll tax rules in each of the states, apart from WA, extend out to individuals who are contractors and who aren't providing their services under an exempt type of contract. So payroll tax involves a much more detailed analysis. And workers' compensation can also apply to independent contractors. Again, you need to have a look at what the rules are in each of the states. The final group of workers that I'm going to touch on today are volunteers. And volunteers, again, are very different to both your independent contractors as well as your employees. So a volunteer is someone who's an individual, but they don't work under a contract that obliges you to pay remuneration for the services that they are performing. However, you may still make payments to volunteers. So honorarium is a classic type of payment. So it's an honorary reward for voluntary services that are provided. And so that might be a small token that's paid to the volunteer to say thank you for the services. So you need to be careful here that it's not spilling over into a payment for a professional service that someone might be provided. An example that the ATO provides is that, you know, someone might be a volunteer, but they're also perhaps an IT specialist, and you know, they come in and they actually perform a whole bunch of IT work for an entity during the year, and they're actually paid for providing those professional services. That's not an honorarium. An honorarium needs to be merely a token to recognise the voluntary nature of the services that that volunteer has provided during the year. It's also okay to make payments as reimbursement to volunteers. So if the volunteer is incurring expenditure that relates to the activities of the entity and personally, and those expenses are reimbursed, then that's okay. You can reimburse those expenses and it doesn't make them an employee. And also, similarly, an allowance. If you're providing an allowance to a volunteer and the quantum of that allowance has been calculated by reference to the expected expenditure of that volunteer, and they're required to repay any unspent amounts, again, that doesn't, providing an allowance doesn't make that that volunteer an employee, so they can still fall into that category. The importance of being a volunteer is that all of those employer obligations just don't apply. So there's no PAYG withholding, you don't have to report it through single touch payroll, you don't have to pay superannuation, and also there's no payroll tax or workers' comp for those volunteers. So a much easier category of individuals to deal with. A lot of information on this particular slide, and I'm not going to go into it in great detail. It's more provided here for your information to pick up after this presentation is done, if you kind of need to jog your memory. But just kind of quickly, PAYG withholding, so there's a whole bunch of things you need to look at to work out, am I calculating the right amount of tax? Am I remitting it to the ATO on time? And am I reporting it to the ATO on my BAS as I'm required? Whenever you have PAYG withholding, there's also single touch payroll reporting, and that would be familiar to most organisations because it's been around now for a few years. But in real time, as you make the payments to the individuals or who are captured by PAYG withholding, you also need to pick them up for single touch payroll reporting and do an annual declaration to the ATO at the end of the year. Superannuation, really important that you get this right. So you need to make sure that you're offering your employees choice of fund, that if they don't provide a fund to you, that you check with the ATO to see if they have a stapled fund, so they've got a preferred fund with the ATO. You need to calculate the amount that you need to contribute for super, and then of course you need to make the contributions by the due date, being the 28th day following the end of the quarter. A little bit of ways away, but payday super is on the horizon, so it's still a couple of years off. But the ATO is certainly looking to move towards having super contributed around the time that the actual salary is paid. So that's just a change to be mindful of. FBT, I won't go into any detail here because that's going to be picked up by Judy in the next part of this presentation. But suffice to say that if you're providing something that's a non-cash benefit, then you also need to think about FBT if you've got someone who is an employee. And I've touched on payroll tax as well. As I mentioned, for many charities and not-for-profits, there's an exemption that's available under state payroll tax rules, but you just need to make sure that you satisfy that exemption. If you do, happy days. If not, then you need to go back and have a look at the sorts of payments that you're making to the individuals and potentially have to pick them up for payroll tax. That gets me to the end of my session. I'm going to make myself disappear and I'll hand over to Judy to talk about not-for-profits and FBT.
That's great. Thank you very much, James. Good morning, everyone. Now to the exciting topic of FBT. So what are we going to cover? So broadly, this particular slide here on specific FBT concessions available to not-for-profits, so a couple of slides on that. And then I'm just going to talk about what's topical And lastly, some other areas of interest. So some of the things that we have been seeing lately when we have been doing work in this sector. So again, welcome everyone. Thank you for coming on and listening to Russell and James and I today. So I just wanted to initially say, fringe benefits tax, what is it? So it is generally payable by employers who provide fringe benefits to their employees or associates of the employees. However, the good news is that not-for-profits do have access to a range of FBT concessions. This slide here does cover some categories of not-for-profits, and the employer, the not-for-profit employer, entitlement to some of these concessions. Before I run through, I'll just mention, you'll see there that there's one capping threshold that does apply to all three categories. So I'll just raise that briefly now. So please bear in mind as I go through these categories that where salary packaged meal entertainment or entertainment facility leasing expense benefits are provided, there is a separate single cap, a grossed up cap of $5,000 per employee that does also apply to each one there. Now, just now on top of that, if I go to the top, we have public benevolent institutions and health promotion charities. In that category of employer, there's an FBT exemption available. It is capped, and that is capped at a $30,000 grossed up amount per employee. Public hospitals, not-for-profit private hospitals and public ambulance services also receive an FBT exemption, and that is capped at $17,000 gross up amount per employee per year. And lastly, we have rebatable employers. So quite a few of you today might be in this category. This can be certain registered charities, non-government and not-for-profit organisations. In this case, not an FBT exemption, unfortunately. Instead, we have an FBT rebate available of 47%. That is capped as well at $30,000 gross up amount per employee, and there's no changes since last year for this area. Moving on also to just for a moment, I'd like to speak about religious institutions. I know we do have a few registrations for this seminar today in this sector, noting there are some potential FBT exempt benefits for religious or employees of religious institutions. The main one that I'd like to talk about is in terms of religious practitioners. So there can be FBT exemptions for benefits provided. So there are conditions, as you would all imagine, and those conditions include the employer is a registered religious institution. So that's broadly a ACNC registered charity with the subtype of advancing religion, and the employee is a religious practitioner. The benefits are provided to the employee or to the employee's spouse or child, and the benefits provided are principally in respect of pastoral duties or any other duties or activities directly related to the practice, study, teaching or propagation of religious beliefs. So a bit of a mouthful there, apologies, but there are these conditions that are required to be met. If you would like more information on that, taxation ruling 2019/3 does provide further information, and also there is some information at that link that we have on the slide there on the ATO website. And just lastly, there are also some more FBT exemptions in relation to living carers and domestic employees. Again, if you look at the ATO website information, that will contain some more information that you can see on those exemptions that are also available for that sector. What's topical? Some of the topical matters that we thought would be helpful to cover today. Firstly, if the organisation is FBT exempt, so for example, a public benevolent institution, health promotion charity, so just bearing in mind what happens where the employer may provide some additional benefits. So just to clarify, so in this sector, very commonly, there's widely applied salary packaging, and often that salary packaging is organised so that it does cover up to that 30,000 grossed up cap that we talked about before. So the employee, say, is already utilising that cap in the salary packaging arrangements that they've put into place with their employer. And then the employee is provided with a further benefit. And quite commonly what we are seeing is an employee might be allowed to drive a vehicle home. So a vehicle provided by the employer drives it home overnight. So therefore, that would be seen as being available for private use, and therefore, Fringe Benefits Tax can apply to that. Now, what you might see where we're going with this is that where the cap has already been maxed out, that can then result in an NFP liability for the employer. So that's just so what's topical is just, especially this time of year, when we are getting into that lead up. I can't believe it's February already. So we're really getting to lead up now to the FBT season, because the FBT year does end on 31 March. Just bearing in mind that where some decisions are made in terms of particular benefits that might be provided to employees, that there could be an FBT liability that arises where they've maxed out their caps. The other topical item in particular that I wanted to raise to you all today is stage 3 tax cuts. So probably wouldn't be a webinar without touching on something like that, since it's all over the news and has been for weeks now. So what we mean by that is just looking at the stage 3 tax cuts that are due to commence 1 July this year. So we've got a note there, it's currently under revision by the federal government, so it was law, and then you may have noticed that the federal government made some announcements recently to change those tax cuts. Now, as of yesterday, the changes to the stage 3 tax cuts, the bill was introduced into the House of Representatives. The point that we wanted to raise here is particularly for the rebatable employers, that your employees may not be as better off, or even better off at all, under the salary packaging that you might have in place once these tax cuts come into play from 1 July this year. So this is due to there are changes in the marginal tax rates, and so they are effectively decreasing in and meaning that the tax will be lower. Point is, FBT is calculated at the top marginal tax rate. So now, but that is less, so top marginal tax rates, but less the rebate. So if you're a rebatable employer, you then take the rebate off, and hence why employees may still be better off to salary package, because after the rebate is applied, the FBT might still be lower than what the tax would be on if they took that in cash instead. What we're saying though is to revisit that, is to look at these proposed tax cuts. Possibly will be time to go back, maybe have to run some more calculations just to see if under the new revised tax cuts, if those employees are still going to be better off with salary packaging. So just being mindful of that is what we wanted to mention in this particular slide. Now, I just also wanted to look at some other topical matters before I finish my section here. These are more some matters that we have been noticing when we are doing work in this sector. Now, one of the first ones on the list here is knowing your organisation's FBT status, FBT exempt status or FBT rebatable status, or no concessional status at all. So what I mean by that is we have seen quite a number of situations in the last 12 months or so, in particular where the organisation, the entity, the employer is actually an FBT rebatable employer. However, they are applying the exemption. The Australian Business Register does have the information about endorsements. So to be entitled, especially for charities, to be entitled to the FBT exemption rebatable, that is potentially a handy resource to also check on the Australian Business Register, particularly for charities, because the endorsement will be up there. So just bearing in mind, and rebatables, you can also get some similar information, just bearing in mind that especially when there's new staff at a organisation, like a new finance manager, etc., is we have had situations where that finance manager has reached out to us because they've realised that the organisation is FBT rebatable and endorsed for that, but is applying exemptions. Can I just also mention that we have talked about regularly and on these slides here about exemption status, rebatable status. To be exempt or rebatable, you do need to meet certain conditions. So it doesn't mean that all not-for-profits are going to be either FBT exempt or FBT rebatable. Instead, there could actually be no concession at the employer level at all. So just bearing that one in mind as well. Secondly, rebatable employers in particular, just wanted to raise the tax-exempt body entertainment and minor benefit exemption. So what we're talking about now is where a organisation is income tax exempt and they do provide entertainment. Broadly, that means that technically, for FBT purposes, that will fall into tax-exempt body entertainment as a category in the FBT law. Why am I talking about this? One of the key impacts of that is there is very limited use of the minor benefit exemption available. For example, it would be fair to say that an FBT rebatable employer, if they have a Christmas party, they could most likely be subject to FBT on that Christmas party. and not to think that the minor benefit exemption will apply to that. So this is an area that we find is not always known, and we're just talking entertainment here. So other benefits that don't fall into entertainment, the minor benefit exemption is still available. We're just talking about the interaction of entertainment and that exemption. And just briefly, for those of you that might be sitting there thinking, what is the minor benefit exemption? Just saying that that is an exemption that's available under the FBT law, and broadly where the benefit is less than $300 and provided on an infrequent and irregular basis are the main conditions for the minor benefit exemption. So just lastly, we just wanted to mention, hopefully you all are enjoying this webinar and getting some great takeaway items from it. So we encourage you to come along. We do have another webinar that we have organised for the FBT compliance season. So I just wanted to raise that mainly because you can see today I haven't talked about the 2024 FBT year in particular, and any changes that are happening for that. Reason is that we do have a specific webinar. It'll be on the FBT changes, ATO insights and ATO focus areas. Registrations are now open, so they're now open for the BDO webinar, and it's going to be held on the 12th of March. So Tuesday, 12th of March from 11 to 12, that is AEDT. So I am in Brisbane, so for those fellow Brisbane persons attending today, so that would be 10 o'clock for us because the daylight saving is still on then, and we've just got our link to the BDO website. So thank you for listening to me. I'm now going to hand back to James to consider questions.
Thank you very much, Judy and Russell. That was really informative and covered a lot of material there. We did have a couple of questions that popped up today and in the registrations. Russell, I might go to you first, if you don't mind. You mentioned about the Productivity Commission, and the question is BDO making a submission? And if we are, what are the sorts of things that are being covered in our submission?
Thanks, James. Yes, we certainly are making a submission, and that we feel that just based on our interaction with our clients and with both the not-for-profit sector and those who are ordinary taxpayers, that things like the tax deductibility of donations is a critical issue to them. It also impacts significantly on PAFs, private ancillary funds, and public ancillary funds, because they're often established with tax deductible donations, and so that changes them into the future. We're also going to share with them some of the data analytics that we've done. We've developed a package that is sitting around the data that is released on the ACNC of all of the charities, where we can map a charity against its comparable entities and compare growth, key performance indicators to help that charity map out and assess the benchmark themselves against the others. So we will be sharing that with the Productivity Commission to see some of that data. But certainly, yes, we'll be putting that in later this week, and I dare say it'll then be available to the world at large.
Excellent. I imagine you've got a busy week ahead of you, Russell.
It has been busy. Almost complete.
Oh, excellent, excellent. Judy, a question for you, and this I think involves probably a couple of different elements. So, for FBT exempt entities such as PBIs and the like, does their exemption mean that they are fully exempt on the private use of a utility vehicle? A lot to unpack in that.
That definitely, and that is a classic question. Thank you, James, and thank you. And I'll try not to talk too long because I could talk for definitely the rest of the webinar on that one. So that is a great question because it's very topical as well. So just topical in the sense that for everyone, not just not-for-profits too, is the exempt vehicles area. So what that question I think is relating to there is your commercial type vehicles, so utilities. So point is, if the organisation is FBT exempt, it doesn't mean that they're also exempt on these utes. So on commercial vehicles, there are different rules that apply. So again, if you can just bear in mind, yes, sure, there is the fact that there is an exemption up to the 30,000 gross up cap, so that's available, and that's just that broad exemption. If we just look separately for a moment outside of that, and look at just say a vehicle is provided on top of that, let's keep it nice and simple. So the employer does have some utility vehicles, and they are now being provided. So say the cap's already maxed out. So now when we've got that situation, just bear in mind there are some specific rules around exempt vehicles, and the main one I'll just mention is the incidental private use. So there are strict requirements about the private use of those vehicles, which effectively is just for your home to work and your minor, infrequent and irregular travel. So in answer to that question, no, it doesn't. There are separate rules that you would have to look at to see whether such vehicles like utilities are going to be exempt or not.
Excellent.
James, did you want me to also field, I think there are a couple of other questions I can see in this area for FBT?
Go for it, Judy, you're on a roll.
I'm on a roll, everyone. So I will just hog the spotlight for a moment. We also did receive another question. If we have an Australian employee working full-time overseas, will that employee be able to enjoy tax-exempt fringe benefits like any other employee working in Australia? Yes. So good news on that one. The FBT rules apply. They apply just the same in that situation. So I want to mention that. And just very quickly, lastly, we also had a super guarantee question come in that I thought I would quickly field also. So this question was around, will the ATO consider a minimum amount paid limit? So there was the $450 limit. It was removed from 1 July 22. So the question is around, well, will that come back? Unfortunately, I don't think we're going to see that come back. If anything, the payday super, which I think James did kindly touch on earlier, which is a regime that's proposed to start for 1 July 26. That is, I guess, on the table in that sense, in that there is consultation that has occurred, and there are moves to this potential regime around contributing super on the day that the wage is paid. But also at the same time, there is a more broader sort of review, if you like, of some of the other super guarantee legislation as well. So all I can say is perhaps something further might come out of that process, but at this point, as far as I'm aware, there are no plans to bring back a minimum amount again.
Excellent. Yeah, and I wouldn't think that that's likely, just I guess given where the government is going to. They certainly identified casuals and perhaps lower paid workers as the one missing out on that, and so that was a real target for them. So I'm not sure I'd see them backing away from that. And as you say, given we're well down the path now of talking about payday super, I think that's it's like the government views that everyone should get superannuation regardless of the amount that they are being paid. So yeah, I think that's I agree completely with that, Judy.
Great.
Well, I think that unless you guys saw anything else, I think that covers the questions that we had through on the chat and through the registration process.
I was going to
so
say,
if that's all that's there,
the media,
oh, yep.
James, did you see the media yesterday? There was a fellow that was talking about his ute and his concerns over the carbon, but he was then referring to how his dual cab ute, he puts the two kids in the back and goes to the beach and to go surfing. And I thought may well get a contact from the tax office. So it's a good reminder to everyone that the tax office will regularly look at media, and you know, if you're in there, just be mindful that whatever you say or do, or whatever you put on your website of your organisation, your NFP, that material can turn up, and so to make sure that you're ready to be able to respond if you that it all can withstand scrutiny, because it's amazing where that information will come from.
Mhm. And just to comment on that, thank you, Russell. What Russell's saying there, of course, is that there is those limitations on private use of the vehicles. And unfortunately, if you're, taking the vehicle to the beach or so there's the essentially if the private use is not minor, so beach trips, fortunately a little bit extended, etc. It's not minor, infrequent or irregular. So again, you see, and I thought, Russell, you might be about to say this as well, you see sometimes where the company with their logo, etc., is on the vehicle, and it's up at the, sporting fields on the weekends, on Saturday mornings, because taking the kids to sport is another classic area. That could be considered every week, so that would be regular. So just what we're saying here, just the point of it, is that if that private use condition is not met, then the risk is that the vehicle is no longer exempt at all, which unfortunately means that for the whole year, that vehicle is then actually subject to FBT. So that is unfortunate. So thank you. That was a good point.
And the rules are incredibly draconian. 1 kilometre deviation takes it outside the rules. It's just, so everyone needs to be very, very conscious of that.
Yes, and there is a practical compliance guideline that does, if you do meet the conditions to apply that, there can be some safe harbours and then some declarations around that can help employers with the application in practice of these rules. But yes, that's, I guess, another area to look at. But as Russell, as you said, with the normal legislation, you have to be very careful about diversion of trips. So home to work is actually okay in terms of private use for a exempt vehicle, but once you divert in that home to work journey, there is a risk that the exemption is no longer available.
So James, I had a question put to me just about the lodgements for the non-charity self-assessing. It will be a bit like a tax return in that tax agents can help out. So do identify that with some logic. It's a 31 October because that's the date that all tax returns are specified, unless you get yourself onto a tax agent's list. So for the NFPs, it'll be the same, to be able to get yourself onto a tax agent's list, to give a bit more time to allow that to be collated. And if I can just reinforce the value of just identifying what are your substantive provisions, because certainly in Queensland, the law has just changed around incorporated associations and a very big relaxation of audit requirements. So you don't want to have it that your constitution says that you must have an audit, but the law no longer requires it, and you think, oh, beauty, I can not have to do the audit and incur the cost, but you need to ensure that your constitution is then updated and to match what your activities are, to avoid any mission creep, that suddenly you find, well, we're doing something, but it's outside what we'd actually said we were going to do in our constitution as our objects. So lots of things to think about there with going forward. All good, healthy governance issues that are appropriate. And that mission creep is an issue for charities as much as it is for the non-charity self-assessings.
Excellent. Well, I think we're all just about at time. So once again, thank you very much for joining us today. And I hope you enjoyed the session and found it valuable. The slides will be available. They'll be sent to you after the conclusion of this session. And as Judy mentioned, we really would love to see you in March for the FBT webinar, and hope you can join us there. But thank you very much once again. Enjoy the rest of your day. Thank you.